Mr. Ken Heinz is the president of Chicago-based Hedge Fund Research, and he joins us live from in the studio right now in Hong Kong. Thank you very much for joining us.
Thanks, Phil.
It's an interesting statistic that perhaps hedge funds closures, or the lack of them, is a bullish signal for the markets. And maybe it's wrong, but what's your thoughts on that?
You know, it's really interesting. In the most recent quarter, we've seen a liquidation of just about 177 funds, less than 2%. So that attrition rate is declining. Just to tie that into the earlier part of the story, if you look back to the fourth quarter of 2008, for example, the single most hedge fund liquidations in a quarter, over 700 funds liquidated in that sort of liquidity vacuum that ensued there. And so I think it's indicative of the fact that the industry is recovering from the financial crisis in the way that many other aspects of the financial industry are. And it's just another data point that shows that's moving along. You're seeing steady amount of launches, not a huge uptick, but steady. And you're seeing much fewer fund-to-funds liquidations. As you know, that was an area very out of favor 2008 throughout most of 2009. And we're continuing to see improvement in that area as well.
You know, when we look at the overall marketplace, Wall Street, places like Tokyo and Hong Kong and London have lost a tremendous number of jobs in the hedge fund space over the past 2 years, even prior to when Lehman went down because of the mortgage-backed securities issues. Are those jobs going to come back, or is this the new normal that we're talking about where it's relatively small? We're not going to see a lot of new funds opening up, as you mentioned, maybe a trickle here and there. Are those jobs gone permanently?
I don't think they are, because when you really look at so far, the hedge fund industry has not recovered entirely the peak asset level that it saw, but it is approaching that, and we've seen gains in the last 3 quarters. So the asset level and the number of funds are coming back. It's coming back, I think, as a reflection of the risk tolerance that investors are continuing to harbor. It's coming back more slowly, but it is coming back, and I do think that it's sort of interesting that if you think about a lot of the proposed financial regulation, the idea that the government, be it in the U.S. or otherwise, are really interested in extracting out the divisions that are trading proprietary capital and moving a lot of the trading entities outside of the corporate structure, is very good likelihood that you could see a lot of large funds launch as a result of that.
We see that now with the Goldman guys. The prop desks, essentially, they're shrinking, and there's a number of prop desks just in this city alone that I know have basically shut down over the past 6 to 12 months, not because there's not enough business or not enough capital, because they don't want to deal with the regulation that might be coming down the pipeline over the next couple of years. And as they move off to these hedge funds, that leads to the next question here, which is fees. We talked to a lot of big investors out there, and one in particular I can think of, which I won't name, but there's always been these complaints about paying the 2 and 20, and some hedge funds even charge more. But since the Lehman crisis, a lot of the hedge funds cut some of their fees.
Yeah.
Now, as this economy and the hedge fund community sort of reverts back to semi-normal, are we going to see fees increasing, or are we going to see more discounting in fees going forward?
It's an excellent question, and the reality is, as part of the report that we put out today, we actually have an entire chapter that is an analysis of the industry fee structure. So you see it modularized by performance by different fee structure groups, both management fee, incentive fee, and you see the changes in those over time. So the somewhat ubiquitous 2 and 20, which some funds do charge, the reality is there is a distribution of fees where some charging 0 management fee or lower incentive fee. But I think as you look at the average across the board, you've seen the average management decline. It's closer to 1.5%, which might not seem like a lot, but it is a lot when you think about on almost $2 trillion, it adds up a lot. Same with the incentive fee. That has also come down. The idea that it's a standard given 20%, you're seeing people come in at 15, people come in at 10%, bringing that average down to closer to 19.
Good stuff. Okay, thank you very much, Ken Heinz.